Good afternoon and welcome to this Yellowstone Advisory webinar with Capita PLC. You'll see that there's a poll on your screen asking if you're a shareholder, and it'd be very helpful if you just complete that poll while we wait for everyone to join. And while we're waiting for everyone to join, I'm just going to go through a few sort of admin points. We really encourage questions, and there's a Q&A box at the bottom of your screen. If you have any questions, please type into the Q&A box and we'll deal with all those questions at the end of the presentation. The format today is we've got a presentation from Stuart Morgan, who's Head of Investor Relations at Capita. And following the presentation, as I said, we'll have time for some questions. I'm just going to wait for a few more seconds as people join and complete that poll. But we're looking like we have a majority of shareholders joining us today, around about 75% shareholders, so that's useful to know. I think that's all the admin that I want to go through now. So without any further delay, I'm going to hand over to Stuart Morgan, Head of Investor Relations at Capita, to start this presentation. Thank you, Stuart.
Morning, Alex. Thank you everybody for having me. So hopefully you can all see my presentation. I will. There we go. So just to give some background as to where we are, what we're trying to do, and how we see the future. As most of you will be aware, Capita's 3 years now into a multi-year transformation process. We think in the first 2 years we'd made a lot of progress in terms of fixing things. We strengthened a lot of customer relationships. We really focused on making sure that our customers and clients regained their trust in Capita. We'd disappointed people. We had a number of sort of high profile mistakes on particular contracts. So, I mean, the principle here is obviously you're not going to win new revenue unless you fix things and rebuild trust. So that's gone particularly well. We've seen a high degree of rebuilding trust. Our employee relationships have improved significantly, and generally the background, the operational side of things is going well. We've taken a significant amount of cost out of the business. Again, things within our control we have done well on, we think. Now, obviously, this has been to offset revenue declines. Those revenue declines have been a reflection of what was happening in the past. So structural declines in some of our life and pensions businesses are things that have been going on for a while. We lost some local government contracts last year. Again, we were notified of those 2 or 3 years ago. But underlying revenue is now more stable. And we are also now starting to win and renew some significant contracts, and we are rebuilding the pipeline. So sort of reaching that inflection point on turning Capita into a sustainable and growing business in the future. Now, 2020 was supposed to be the year where we inflected into positive revenue growth and positive sustainable free cash flow. Unfortunately, COVID hit us as it did everybody else. Our first quarter was on track to deliver what we expected to, so we were on the right track. And then obviously since then, COVID has been something that we think we have coped well with. The first thing we had to do was prioritize our colleagues' safety. We then focused on our clients and making sure we could continue to deliver for our clients. The main part of the business has been resilient, so sort of 90% of the business has been long-term contracts, which we continue to deliver. And then we've addressed it with some cost and cash preservation measures. We thought we could take out £100 million worth of short-term savings in the business, and we'd done an awful lot in the first half, 57 million of that delivered. and we will be looking to see how much of that we can continue with as our sort of operating model evolves. This COVID has put pressure on the balance sheet. I don't think we would shy away from saying that. It has meant that we have accelerated some strategic decisions that would probably have been done in a couple of years' time, and in principle, in particular, that's been around sort of the software division and the fact that we are going to dispose of some products and non-aligned parts of the software division, and we will be using proceeds of that to strengthen the balance sheet. And then sort of going forward for the rest of the year, as I say, we expect transactional impact on revenue, but things have been going on track, so they have not got worse since we talked about them last. We've got a lot of cost benefits coming in the second half, as well as some of the cost and cash preservation benefits that we talked about earlier. We're very focused on meeting the H2 covenants, which is something that we've been very strong with our shareholders on. We said that we are going to inflect a sustainable free cash flow now in sort of 2022 and 23. All that really means is that a lot of the cash preservation issues that we have benefited from this year, and we had a very strong first half position on cash, some of that unwinds next year. So for example, the VAT deferral of 117 million, it just means that 2021 looks like or is a less clean cash flow story. But however, underlying cash flow will continue to improve to the extent that we now think sort of, as I say, 2022 will be a year of cash flow inflection at the bottom line. So net debt starts to decrease at that point. And then finally, as I say, we continue to focus on making this a more sustainable and cash and growth business in the longer term. So the transformation is about simplify, strengthen, succeed. We still use that, but the business is very complicated, it's very complex. So we've had to reduce the number of divisions. We are taking out layers of management. We are bringing people together. Part of that is the cost-based benefit that we talked about. We have strengthened our control over the business, invested in things like HR, things like a group legal function. Both of those are things that we didn't have before. We've invested in technology to support that. So we put in the Workday HR tool last year, and that's driven huge benefits this year. We put in Salesforce. We're partway through an SAP implementation. So some tools that the business needs to drive control and efficiency going forwards and allow us to build our pipeline at the same time in terms of growth. And we are also building what we think is a more purposeful, progressive business going forwards. ESG is a key theme of the markets at the moment. I think we would see ourselves as being a leader in that area. We've got 60,000 people who work at Capita, and we are very focused on empowering them and allowing them to do their work better, which will lead to better client and customer outcomes. COVID, I mean, when it hit, our response to that was firstly that we started addressing it early. We put a team in place right at the beginning of February. So when the lockdown did happen in March, we were very well prepared for it. We very much focused initially, as I said, on getting our people back, rather sort of getting them safe, feeling safe, allowing the people who needed to work in offices to be able to do that. 10% of our people were able to be working within 3 or 4 weeks of lockdowns. We were very focused on our clients. So again, the SLAs, our sort of service level agreements and KPIs, have remained incredibly high in the meantime. And as I said earlier, also cash preservation has been a strong theme of managing our way through it. I think our focus has been very much in the moment during the year, dealing with COVID, making sure that everything remains robust and resilient. But there are also opportunities, we think, going forwards now with something we call sort of future ways of working. I think we've talked a lot about property, reducing the property portfolio, using digital internally as much as the market sees opportunities externally, reducing sort of cost lines like travel, which will obviously, I think, be done very differently in future. More specifically, on the left, we gave an example of our customer management team. Very quickly, we were able to get people working from home, and that's been hugely supportive of our strength and client relationships. We've had quite a lot of renewed contracts through the year, reflecting actually, frankly, the need for people to do that in the short term, but also people trusting us to do it in the longer term. And then in terms of cost and cash savings, discretionary things like travel, as I talked about, professional services, marketing costs reduced, more effective marketing, I think is something we would talk about. In terms of people, the board downward through the business to a certain level took temporary cuts to support the business. We cancelled our bonus scheme for the year, and we were able to put some of our people on furlough, although not as much as we initially thought, because actually some of the work we got off government meant that we were able to redeploy them rather than needed to furlough them. I think it's also important to note that we won about 80 million of revenue by the half year, and that continues to be something that we work with the government on. And then finally, as I sort of mentioned again earlier, property and other costs, particularly at group level, we save 4 million at the half year, but more opportunities there, both in the second half and going forward. So coming back to the transformation, our priority has been fixing underperforming contracts. We've called out the Army RPP contract, the recruitment contract for the Army, NHS England PCSE, which is effectively sort of back office parts of the NHS, and Mobilcom Debitel, which is a sort of a European telecoms company. There were 3 big contracts that were losing us a lot of money and were used as exemplars of how we were improving the way we run and manage these businesses. We've made huge strides forwards. We were hoping to break even this year. COVID has meant that some of that is now being pushed into 2021, but we still think those are going to be profitable in the very near future. Operational efficiency, we're just getting better at doing things. Teachers' pensions, some of the benefits we've driven from that meant that we renewed that earlier this year. DFRP was a new contract where we run the Defence Fire and Rescue Services. That's a great example of a big new government contract that is absolutely now being managed very well and is going to plan. We're hitting all of our KPIs. And actually there's some opportunity to win new business on DFRP. So using tools, using better management teams to better manage contracts, and therefore there's no downside to those new contracts. Renewing contracts on better terms, part of what we're trying to do to lift margins going forwards. Last year, I think we were very clear that our renewals, whilst high, were probably initially focused on retaining the revenue and slightly at the expense of taking lower margins. We now think we have the right, we've invested in the business to improve terms of contracts as we renew them. So that's been a focus this year and will be next year. And then finally, rebuilding margins through targeting higher margin contracts, through being a better disciplined bidding company. The TfL congestion charge example was one where we think sort of the elements to that we will build through the ultra low emission zone extension and the congestion charge extension allow us to rebuild margins through that, as well as other opportunities in government. So it's about taking away the downside, improving cash generation, from underperforming contracts and then starting to move things forwards in terms of renewing at higher rates and then bidding on better, higher margin contracts. So just sort of coming back to fixing the underperforming contracts, the example we used at the half year was the NHS PCSE one, significant cash improvement. It's probably important to note at this point, profit performance has been better than cash performance. Cash will follow. So whilst they will all break even next year, it will probably be a couple of years before cash breaks even on those. So that's very much a focus of the business. But we are now winning new business from the NHS, in particular through COVID, which again is representative of a stronger customer relationship. Transformational cost savings continue to do well. We sort of cut this up into 4 bits. Operational excellence is about doing things better, doing them once, reducing the number of mistakes. That is driving significant cost savings. Optimization is taking out structural inefficiencies. The biggest opportunity here is that Capita used to be a business of around 300 different business units and entities. That is now significantly reduced. And we are developing shared service centers across businesses and divisions. Technology, obviously, within the business as much as externally as a driver. We are seeing a lot of sort of take up of automation opportunities, and we are consolidating some of our digital development into our new DDC in India in particular. And then finally, group costs, procurement savings, benefits from things like Workday, Salesforce, and our finance systems. So I think the way we look at it was central costs last year were probably at a peak, representing the level of investment we needed to make to gain control over the business. And we will now look to drive efficiencies going forwards as some of those investments pay off. Coming back to growth, we are winning more of the right sort of work. And this is, as I say, it's through account management, it's through renewals, and it's through rehabilitation, and also the investment in digital data as Capita becomes more well known for some of the capabilities we have. And it's a mix of both government and private companies. And we've given some examples there. I think, as I say, I've spoken to the ultra-low emission zone extension. Telecoms client in Europe has given us a 2-year extension. The Irish Water was a good new contract for us, and we won that in a competitive bid in Ireland based on some of the sort of fundamental value add we bring in customer management, new digital customer experience tools, data analytics. And then finally, one of the UK regions, the NHS, we've deployed a new healthcare decisions tool, which is sort of initial triage analysis, which actually we were able to deploy as part of sort of some COVID support as well. At the half year, we flagged 3 major contracts coming up, a Navy training one, which we expect to find out soon, and then a couple of opportunities, insurance and mortgage services, which would probably now be pushed into 2021, but remain sort of some key targets that we have in the pipeline. Just dealing with the software portfolio, what we've said is, whilst software remains crucial to what Capita does, and we have tens, if not hundreds, of software tools throughout the business that we use on a lot of our contracts, the software division in itself has some products that are not going to be core to what Capita does in the future. So what we have is some proprietary software like the Capital One product, where we think rather than the sort of the local government housing that we currently use it on, we have opportunities to use it in other areas. We will also start to use third-party partners as part of our tech stack, but also as ways of developing new tools. So we've recently developed a grant distribution tool, which we've basically used an element of Salesforce to leverage off. We currently have some new customers for that, but see a huge amount of potential to use it in different areas across Capita. And then finally, sort of microservices. So our 999i product, which we currently use with a number of sort of police forces around the world, which is effectively a mobile link which develops secure and private data for police services. We actually were able to use that when COVID started as a remote GP consultation process. So again, it's about taking some principles of what we do and deploying them throughout Capita. So those are the things that we are going to continue with and keep developing. And the plan is to do this mostly through the Digital Development Center, which is our investment in India, where we get economies of scale and significant capability benefits, which will now be able to develop these throughout Capita. In terms of strengthening the balance sheet, as I mentioned earlier, we started the year comfortable that we would start to reduce net debt as the year went through. COVID, unfortunately, meant that we aren't able to do that. We are focusing very much on building the operating cash flow, but that is probably, it's going to be significantly better this year than it was last year, but that will continue to improve going forwards. The key for us is the debt maturities coming up in the next 2 years, and therefore, as I said, we are accelerating some of the disposals, and we will be using some of those proceeds to reduce net debt and as a contribution to pension liabilities. We are also going to be talking about future disposals going forward. So ESS, we expect to complete soon, but other software businesses, products, as well as maybe 1 or 2 other things from around the group, we will continue to look to dispose of those in due course. And then finally, we will continue to look at the bond market as an opportunity to extend our maturities and as a less constrained way of investing in the business. Just moving on to each of the divisions. Software, it's a very nice, high margin, cash-backed business. We've continued to invest quite significantly in it in the last few years. So for example, the ESS SIMS product, we've developed a cloud tool for that. We've continued to invest in some of the microservices like the healthcare decision tool. We, as I say, will continue to use it as a fundamental part of the business. And in the meantime, we'll also look to consolidate some of the software capabilities through the group. People Solutions is probably one with a significant amount of opportunity, but is further behind in its transformation, just in terms of us being able to get the right people into that business. It's got 4 key pillars now: a pensions administration, a learning, a resourcing, and an HR solutions business. It's got a good mix of government and private business within that. We think they are quite interesting growth markets. We've seen a high level of renewal in People Solutions this year, and we will look to start growing that business going forwards. And as I say, we've invested in things like security, watchboarding, and an onboarding tool, which we think will start to derive some growth from next year. Customer management, one of our biggest divisions, number 1 in the UK, a value add proposition for our customers. We've invested in, as I said, customer experience, digital platforms. It's about now driving the benefits of that investment going forwards. We do have some revenue attrition. People are using the current environment to take a few things back in-house. But as I say, we've got some interesting things we think we can do to drive this business forwards, as well as taking cost out with a global delivery center. So leveraging India as a as a digital interface and leveraging South Africa as the people part of it, to reflect what people want. Customers and clients these days want more self-help, more ability to serve themselves, but in a way that leaves fewer people disappointed, and giving an uplift in customer benefits. Government services. I think the key to government services is that perhaps 3 or 4 years ago, exposure to government was seen as a bad thing. Now it is, clearly during COVID, it's been hugely supportive, but government is also now using its outsourcing playbook to recognize that they were not being fair to their outsourcing partners. We see the outsourcing playbook as a key partnership tool. We talk to the Cabinet Office in particular a lot. We've got some strong relationships across local government and some particular government verticals, DWP, NHS, MOD, and whilst we've had a negative impact this year from the local government exits, I think the government services division has some quite interesting opportunities going forwards, not least a very big pipeline, given that is the nature of government procurement, potentially with some tailwinds from frameworks to get infrastructure and people back up and running after COVID. Technology solutions, as an external facing division, it has improved significantly in the last couple of years, as a partner to things like the Scottish Government. We deliver their wide area network. We deliver a lot of IT solutions to private companies. I think Tech Solutions has an opportunity in particular from COVID to benefit from investment in cloud, data, cybersecurity. These are all capabilities we have in-house, which we probably don't leverage externally well enough. So Tech Solutions is a combination of servicing other parts of Capita, but at the same time going to market with some propositions that we think fit what are going to be huge areas of growth in the next few years. And then finally, specialist services. I probably should have talked about this earlier. This is again a collection of good businesses that are non-core to what we see Capita doing going forward. They were all ready to be sold as COVID hit, and we were going to sell them as one package. There are some businesses in particular in specialist services that have been really hard hit. The travel and events business in particular has had a difficult year. Enforcement and local councils in the second quarter, nobody was wanting to collect cash off people. Interestingly, that came back a bit quicker than we thought it would as people realized they needed the money. But we've also taken the opportunity in the second half of the year to right size these businesses for what we think they're going to be doing in the next 2 or 3 years. So the idea will now be that they will be sold off probably in smaller packages or individual bits in the next 18 months. And eventually the specialist services business will fall away. So that is another opportunity we have to strengthen the balance sheet. So in summary, we are managing our way through COVID. It's been actually a good year in terms of maintaining service to our clients. Our resilient revenue base, long-term contracts being delivered from 90% of the workforce, 50,000 people working from home, SLAs, KPIs all being maintained, and we very much focused on cash and cost preservation to maintain the financial stability of the business going through the year. Strengthening the balance sheet. We expect news on ESS soon. Proceeds will go towards strengthening the balance sheet again. And in the meantime, we are expecting to meet our year-end covenants. We will continue to make progress with the transformation. We'll continue to simplify the business. We think we've got some attractive growing core markets, digital, government, Outsourcing is an interesting area of growth. We are focused on what we call grinding the margins to improve cash margin performance. Accounting brings some complexity, so we are more focused on cash than the profit at the moment, but they will converge in due course. And then, as I say, in the longer term, our ability to drive increasing sustainable free cash flow, whilst delayed because of COVID, we think is still our objective in 2022 and beyond. And on that, I will take questions.
Stuart, thank you very much for that presentation. There's clearly an awful lot going on at Capita, and look forward to further updates. We've had a couple of questions that have come in ahead of time and a couple during the presentation. If you do want to ask a question, there is a Q&A box at the bottom of your screen. If you could please just type your question into that, and we will endeavour to deal with all questions now. So let's start off. This is one I guess I would describe as getting straight to the point. If you have engaged with Montague on the sale of ESS, presumably they have offered a sum that is acceptable with the board. Can you give any more information on expectations about the amount to be realised and a timetable to get this done?
I can't really comment on the price, other than we will do our best for shareholders, and we've run a very thorough process. We've had a lot of people interested in it, and in terms of timeline, our expectations are that we'll be able to announce something relatively soon.
Great, thank you. And in terms of other non-core assets, can you give us some more information on what other non-core assets are available for sale, and how much in aggregate could they be realised from these sales?
So I think if you look at the software division, we had a software seminar day a couple of years ago where we highlighted some of the products that we have there. So there is a tool called Retain, which a lot of the consultancies and professional services businesses use. PwC, KPMG, Capgemini all use it to manage their people. There's a utilities asset management tool that some of our utilities clients use called AMT Cybex. There is the software solutions tool, which is emergency response management. So there are a number of products within the software division that don't fit from what we look at as being long-term parts of Capita. What they represent is probably somewhere between 1/2 and 2/3 of the software business's revenues, and are probably about half of the profit. Will likely be disposed in the next couple of years. I think through the rest of the group, there are other things that we will continue to dispose of and simplify. Now, these are not necessarily going to be hugely cash generative. So one of the things we announced last week or the week before was the benefits business in the people division. That is something where we were subscale and not making any money. It was about 6 million of revenue and was losing £6 million of profit a year. That is an example of a divisional streamlining, where we will be getting rid of things that drag rather than selling things that realize profit. So there's more to come. I think the next 18 months we'll see most of that come to the market. And I think, again, I didn't really talk about it. I think the way we see Capita going forwards, it's gone from 10 odd divisions a couple of years ago. For the last couple of years, we've had 6 divisions. We've talked about getting rid of specialist services. The software division, you'll get rid of, as I say, maybe around 2/3 of that. The rest of it will become part of a more focused, vertical focused Capita that frankly will possibly look more like something that delivers for things like TfL, where congestion charge, you have technology solutions run the infrastructure of that. So they literally, it's all the stuff that sort of takes a photo of a car. There's a system that processes that. You've got customer management who deal with sort of the people inquiries, the website that will go and take your payment. We have a payment tool Pay360 that processes those. So that's an example of a contract for a customer that leverages Capita's capabilities. So what you might see is the business looking slightly different, but effectively using its position as a digital change agent and enabler and service provider going forwards in some key areas like so government, people, customer management. They will be the sort of a more streamlined Capita going forwards.
Okay, and a question which is linked to that is, why sell the software businesses when Capita's strategy was to become a tech software business, whilst you've got businesses within the group which appear non-core, such as science?
Such as what?
Science.
Yeah, I mean, I think, again, what we're very keen to say is that we have a huge amount of software capability, and software, the software division has a number of products rather than software that operates on specific clients. I mean, an example is in the customer management division, we've got an agent tool which effectively allows them to recognize a person, have a look at their history, and be able to engage with them on a personalized basis. We've developed over the last couple of years. We've re-platformed a lot of the agent capabilities in customer management. In government, again, a lot of the software we've developed is client specific or contract specific. One of the objectives we have going forwards is making sure that our software proposition is more scalable and more repeatable and less bespoke. So where you might have software in the business that is 80% bespoke and 20% standard, our objective would be to have a tech platform that is 80% standard and therefore 20% bespoke to each contract. So it's not about saying software doesn't work, it's just the software division is a construct that has some things that don't really fit longer term in the group. And therefore, kind of at the moment, we are realizing some of those proceeds to reinvest in the business.
Okay, got a couple of questions which I'll give them together because they're about covenants. The first one is, can you meet the year-end covenants if you don't sell ESS? And the other linked question on covenants says, you're confident of meeting covenants in December 2020. When are covenants next tested? And given free cash flow will only turn positive in 2022, will covenant tests in 2021 prove more problematic?
As I say, we've stated a couple of times now that we are very focused and expect to meet year-end covenants. That is without having done the ESS disposal. Given that we've not announced the sale yet, then that is a fact. In terms of going forward, so we have two main sets of covenants we need to meet. We've got Euro notes and we've got US notes. The US notes have an upper limit of net debt to EBITDA of 3 times. The accounting treatment of that means actually it is a more achievable. We've got a lot more headroom within the US notes. The Euro notes are 3.5 times. They're at sort of, so the difference is the way GAAP has treated IFRS 16. It's on a standstill basis for the Euro notes, whereas it's on a benefit of the P&L and it doesn't impact the balance sheet on the US notes. So those are the two covenant constraints that we have. They're managed twice a year, so 30th of June, 31st of December. As I say, we expect to meet them half year this year. We don't have a position going forwards, but disposals and stuff will very much help to strengthen the balance sheet. And I think one of the other things, again, in full transparency, we talked about at the half year of in a severe but plausible downside going concern scenario, there is limited headroom within our current trading environment that excludes the disposal of anything such as ESS. And the caveat that the auditors put around that at the half year was that disposing of ESS is not entirely within our control. Going through that process again, we'd expect the going concern issues to be alleviated with higher amounts of liquidity and more flexibility and more cash generation in the underlying business going forwards.
Okay. Can you comment on the required pension contributions, perhaps some of the key dates going forward on the pensions, and any indication as to the proportion ESS is of pension contributions?
So in terms of the pension actuarial liability, so 3 years ago, there was an actuarial deficit of just shy of 180 million. We agreed with the pension trustees that we would pay that over 3 years. That left 60 million to be paid in 2020. We've paid half of that, which gets paid on a sort of a monthly basis, which leaves 30 million, which we deferred from the first half into the second half. That is one of the tools we have at our disposal going through the half year in terms of reducing or increasing the headroom going through. The next actuarial process is in train, so that is due to complete by the 30th of June 2021. We're in negotiation with the pension trustees on that. We've always been very clear that proceeds will partly need to go to the pension trustees in terms of making sure we are fair in reducing our liabilities. So as I say, kind of the commitment we have outstanding is a 30 million payment that will either go this year or next year, and then there will be likely, given the way yields and stuff have moved in the last 12 months, further contributions needed beyond that payment.
Going back to the divisions now, which business divisions do you think are least understood by the market and have the greatest potential for positive surprises?
So, I mean, I think as I sort of went through them, I mean, I think government is interesting. As I say, I think we now have a very strong government relationship, having had not such a good one. I think one of the things Capita has been very good at is being a sort of a backroom executor of contract operations. What we've not been very good at is using that skill and expertise to sort of get in front of key decision makers. And this applies in government, but as much anywhere else in the business. It's why we launched our consulting business at the end of last year. Now, look, it's an unfortunate time for that, but actually in some areas we've made huge amounts of progress, and government is one of those where we are now engaging with sort of more senior layers of government and C-suites in the private sector to give advice based on what we know about people's businesses. So as I say, I think government, given its commitment to spending more in the MOD, we've got some interesting contracts like the Army recruitment contract, which we worked hugely hard to fix. So that's up for an extension. We're optimistic about that, but I think there's more to come after that. So as I say, government is interesting. I think the people business, as I say, it's of all of our markets, it's quite a high growth market. I think things like e-learning. So we got hit this year by some of our training programs used to be delivered face-to-face. The fire service college that we operate in Gloucestershire lost quite a lot of business. But what we've also been able to do is to start delivering stuff on a remote basis. So I think you'll see quite an interesting pivot in the people business. Resourcing, again, I think we have some interesting niches. We supply quite a lot of resource and expertise for people in digital and project management areas. So I think there's an opportunity there. So people, I think, is going to have a good opportunity to recover. Customer management, as I say, I think you've got pressure from the top line there, but they are doing some really interesting things in restructuring and then investing in products going forward. So that will become, I think, a more focused business. So look, I mean, I think if you look at the 6 divisions we reported last year, software and specialist services had the highest margins. I think, unfortunately, specialist services and the COVID impact means that that's going to be hard hit this year. But the idea is you take those away and you're left with a business that has opportunities to drive higher margins. So once you've taken out the cash drain, once you've improved your day-to-day running of businesses to make them more efficient, once you've extended and renewed and won contracts at higher margins, you've got 2/3 of the business, once you exclude specialist services and software, incrementally increasing margins across a wider base. So I think across those sort of 4 divisions, Tech Solutions obviously I think has an opportunity. Each of them has areas where I think they can leverage their current skill sets and do better at what they already do.
Okay, thank you. Got another question here on cash flows. At the interims, you talked about you wouldn't be returning to sustainable free cash flow generation for 1 to 2 years. If I was an optimist, I might be looking into the second half of 2021 for those free cash flows to be turning positive. Is that being too optimistic, or do we need to wait until 2022 before cash flows are positive again?
I think the structural challenge next year is repaying the VAT and unwind of some of the cash preservation stuff this year. So we had a really good working capital improvement from cash collections in the first half. We think we can do that again in the second half. We used a receivable management facility, saved us or gave us 30 million in the first half. Again, we think we can do that in the second half. A lot of that will unwind in the first half of next year. You then have most of our note repayments happen in the second half of next year. So I think you will see improving underlying cash flow through 2021. I think getting to sustainable bottom line free cash flow in the second half is unlikely purely because of the requirement to pay the debt. But as I say, I think going into 2022, you ought to see some quite positive tailwinds.
Okay. I guess this is a question that sort of links to that, because it's asking about the dividend. When are you expecting to return to paying a dividend to shareholders?
So I think the first objective will be to make sure that the balance sheet is significantly stronger than it is now. We had a target of between 1 and 2 times net debt to EBITDA on a pre-IFRS 16 basis. We are clearly a turn above that. So I think when we get within that range, perhaps more likely towards the lower end of the range, that is when we would be able to go back to dividends.
Thank you. And just a reminder to everyone, if you do want to ask a question, please type it into the box at the bottom of your screen, the Q&A box. We've got a couple more questions to go through, but probably time to take a few more. Next question is on minorities. Can you please comment on the level of any minority interest within group companies?
The 2 big minority interests we have are with a couple of government JVs. So you've got Ferra, which is a testing business, and you have Axelos, which is a professional services education business. They both have dividends payable every year to government. They are in our accounts. It's about 12 million pounds a year. There's a government put option on Axelos, which is due to expire this year. Given the value that we've realised since that JV started, we don't expect at the moment for that to be called. So those are the main minority interest items.
Okay. And coming back to the divisions, Is science expected to continue to be core for Capita going forward?
So science, I'm not quite sure sort of what that means. I mean, I think something like FERA is in science. I mean, science is part of, I suppose, things that we service. So within software, you've got sort of healthcare decisions. Within government, you've got PCSE. I don't think science per se is a focus. I think healthcare will be a focus of the business, both on a government basis and within the private sector.
Okay. We have no further open questions at the moment. So I would ask you, if you leave the presentation today, could you remember to complete the feedback form? I know management find that very useful. So please, as you leave, could you complete that feedback form? I'd like just to thank Stuart for his clear presentation and covering all those questions today. So thank you very much, Stuart, for doing that. I've just had another question come up, so we'll try and deal with that before we go. Stuart, this is one for you. Is this going to be available after it is complete? So I'm not quite sure what that question means, actually.
The presentation I can make available. To be perfectly honest, it's mostly a combination of our full year and half year presentation decks, but if you would like to sort of send it around, I'm happy with that. And
of course, the webinar is being recorded and will be available on the Yellowstone Advisory YouTube channel shortly after it completes today. Just a reminder, by the way, we've got one webinar coming up next week with Myriad. That's on the 17th of December at 1 p.m. It's quite an exciting company, lots going on there. Again, details on the Yellowstone Advisory website. We've had no further questions coming, Stuart, so I will say thank you again for presenting today. It's very much appreciated, and we hope to see everyone again soon.